out, so from 1 years out to 2 to 3, very big pickups. And then importantly in the spread markets, if you go just beyond where the Fed is currently active, which is around the 5-year, you have very material pickups in yield and spread. So you don't have to take a lot of credit risk. You just have to be willing to take a little bit more duration risk, and that will increase your yield pretty significantly. In percentage terms, it's big. In nominal terms, it's not so big. The last point I'd make is, as you mentioned, is it time to kind of go whole hog into distressed? Well, distressed is becoming a very interesting part of the market, but it is a specialized part of the market. We like sort of core high yield as an incremental yield strategy for a more traditional investment grade or more traditional fixed income portfolio, but with roughly 125 names defaulting so far this year, and the default rate kind of standing around 6%, likely going up to at least 8% this year. Distressed debt is going to be a very exciting place to be over the course of this year and into next. We think it's a little premature to get into that market.
George, the conversation you and I have got to continue, and I look forward to doing that. George Bory there of Wells Fargo Asset Management. Up next, your trading diary on Bloomberg TV.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Equities advanced 0.7% on the S&P. Tech very much on top in your equity market rally once again this morning. Good morning to you all. Your day shaping up as follows. The VP, the Vice President, Mike Pence, and the Coronavirus Task Force briefing reporters at 11 a.m. Look out for that. You'll hear from Raphael Bostic, the Atlanta Fed President, a little bit later as well. Then the President of the United States speaking with the Mexican leader at 2 p.m. before delivering a joint statement at 6:30 this evening. Tomorrow morning, the all-important claims data, and finally on Friday, some US PPIs. From New York City, this Wednesday morning, good morning to you all. This was the countdown to the open. I'll be right here tomorrow. I'll be with you on Twitter too at Ferro TV. This is Bloomberg. Is there any reason why intelligence like this would be put in the president's daily briefing and it wouldn't be followed up in person directly with the president himself?
Susan Rice, the second Obama National Security Advisor, writes today in the New York Times that if she had information like that being reported in the papers, whether it was totally verified or not, she would have gone into the Oval Office to tell President Obama. So without getting into what I knew or didn't know, I just want to say I agree with Susan Rice on that point.
How would you recommend that President Trump extricate himself from this now?
In terms of the Trump presidency, look, it's just another day at the office. That's the way it works. Every day is a new day. Every story is a new story. What you said yesterday is interesting, but doesn't necessarily dictate what you say today. What it tells the Russians is we are in disarray and ripe for this kind of provocation.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juicy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Three p.m. in London, 10 a.m. in New York. That means we're 30 minutes into the US trading day in the United States. From London, I'm Guy Johnson with my co-anchor Alex Steele over in New York. Welcome to Bloomberg Markets. Alex, over here, equity markets are in the reds. We've watched the UK budget, mini budget unfold today. But over with you, stocks are up again.
Well, yeah, particularly if you're taking a look at tech, outperforming yet again. The Nasdaq up over 1% within the S&P. Tech outperforming consistently, despite now tech's getting mired into what's happening with Hong Kong as well as China. But you mentioned the budget in the UK, the cable rate now at the highs of the session, reversing sort of a choppier session earlier as we got some of the details, and also focusing in there on oil. We get oil inventories out, a little choppy trading as we're still worried about supply. But for now, it's like a buy tech, sell bond thing in the U.S. So we're going to break all of this down later on in the show. We'll be speaking with Christian Malik of J.P. Morgan. He heads up their oil and gas research there, so we'll be talking to him about the oil inventory numbers. Plus, Tobias Lefkovich, a Citigroup chief U.S. equity strategist, just reluctantly upgrading his S&P target. I use reluctantly very strongly, Guy. We'll talk to him later on in the hour as well.
Yeah, he's at 2,900. The market's at 31. So we'll see what happens to get us to that 29 year-end target that Tobias has got. But as you mentioned, an interesting day here in the UK. The pound is getting a minor boost. Like, to be honest, the market is really just shrugging its shoulders. This, as we've seen, the UK's, let's call it radical plan. That's certainly what it says in front of me, to save the economy. How radical really is it? Well, here is the UK Chancellor of the Exchequer, Rishi Sunak.
I want every person in this House and in the country to know that I will never accept unemployment as an unavoidable outcome. We haven't done everything we have so far, just to step back now and say job done. In truth, the job has only just begun.
It's a £30 billion programme. The pound, as I say, shrugging its shoulders at what we heard from the Chancellor a little earlier. Let's find out why. Kit Duke, SocGen Chief FX Strategist, joining us now on the line. Kit, is that the right reaction? Why isn't this enough to move the pound?
I think because as much as anything else, the focus is slightly elsewhere. We've got the Brexit talks happening separately, and really, you know, sterling's been moving in a pretty tight range against the euro, and third of a percent higher against the dollar is mostly 0.5% higher for the euro against the dollar, which is mostly slightly risk on in the United States with equities moving higher, and some optimism, hope that we'll get some progress on the recovery fund in the next few weeks. So I think the market was prepped that they were going to get something pretty big, even bigger than they thought, but going in the direction that didn't surprise them. But if I had to guess, we'll get a little bit more out of this. But the cross to look at is euro sterling much more than what's happening with cable. That's at 0.9. It's been moving higher for several weeks. 0.9 is the bottom of an upward trending channel. It's going to need something quite convincing to push it out of that pattern.
Well, Kit, what I also thought is interesting too is if you just look at the curve, yields are pretty much going nowhere at this point today on that announcement. Like 50-year gilt yields are just up by 1 basis point. So I have to wonder how you understand the supply demand dynamics of what's going to come out of the debt management office and then what the BOE is going to have to buy.
And I think there's an element of that is it's a double-edged sword in the sense that if everything goes wrong for the global economy, so if we can't find a vaccine, we get we get the worst of the overall economic outcomes that you can imagine, then we're going to have negative rates, a huge budget deficit, a Bank of England trying to buy gilt, and then sterling's going to get crushed. But if we get a better outcome than that, then then that'll be okay for sterling because the bank will be able to get the QE done, be able to spread the cost of the budget. We won't have to try to do this with negative rates. We'll keep a small interest rate advantage on our side, and we're kind of okay. So I think there's kind of quite a lot of moving parts in the middle of all of this. But if you weigh up this move, this is going to make things difficult for sterling in the worst case economic scenario. I mean, really difficult. That's a scenario that gets cable trading down under 115 on this kind of stuff. So, but I think the market doesn't have any appetite to price that at the moment at all.
Kit, as you say, though, these are pairs. So let's talk about what is happening with the pairs. You have a sort of situation in Europe that we are still wondering about. We don't know whether or not this 750 billion program is ultimately going to go through. Viktor Orban pouring cold water on that. Over in Washington, it looks as if we are going to struggle to maybe get the next round of fiscal stimulus from lawmakers there. If either of those two events produce a problem, how does that change the dynamics for the major pairs around the world?
Look, I think if Europe, it's not even if Europe fails the test of engaging fiscal policy to help monetary policy going forwards, which is really what this is. It's a sort of a fork in the road where they can choose to engage fiscal policy in a joined up way, or they can choose to let the ECB do it all on its own, which we've seen before. If they take what I would say was the wrong choice, then we're back to trading euro-dollar, down, bumbling along the bottom of a long-term range, doing nothing, maybe getting back to 110, and just stuck there. If they choose the right path, I think when you get something convincing at the optimistic end of the scenario, I think it's a game changer for the euro on the positive side. There's a lot of people that would just need that much of a nudge to buy the euro. And so I think that opens the way towards a move towards 120 quite quickly. I think it's different in the United States. I think if you get stuck in Congress with things getting done, I think what that does is it really focuses the market more on the election. I think we then look forwards and we say, all right, we are now politically in election mode, and we're going to have to see how things play out in November to see what gets done.
Well, Kit, you make a good point. You brought up the election. There's also the whole Brexit thing, so there's politicking. And I'm wondering, we used to talk about yield differentials as the signal for currency pairs, but I'm wondering, is it COVID case differentials? Is it stimulus differentials? Is it election risk differentials? Like, which is going to have the outside influence?
I think that they all have a significant influence. The thing with yields is that yields have been nationalized by governments and central banks. They don't tell us anything because they don't really move very much. I come in the morning and first thing I look at is where bond yields are. I tell you what, they're not any different one day from the next ever anymore. So we're trading them a little bit on COVID data, clearly, much more on economic trends. I mean, the big question is who's coming out of this better or worse in terms of the outlook for the economy over the next 2 or 3 years relative to where we were. So, we're starting to look just manically at high-frequency economic data to get a sense of how that plays out. All of the fiscal moves are interpreted within the context of, what they're going to do to help your economic story. And I think all of that's what's seeing this gradual shift, if you like, down away from the V-shaped recovery for growth over the next couple of years and down for the U.S. relative to Europe at the same time.
Mm-hmm.
And if you like, that's why Eurodollar is above 113. It's why where we are, and it's why a lot of the emerging market currencies are not joining in the fun, because slower growth's bad.
2 to 3 years. I can't even tell what tomorrow's going to look like. Kit Jukes and SocGen. I'm going to be sticking with us. This is Bloomberg.
La pandemia esto acabó todo. El entrenamiento, el estudio. Entrenar en casa que entrenar en la cancha, ¿no?
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Travel, we did not know when it was going to return. And we knew that when travel returned, it would be different. It would never be the same.
Live from New York, I'm Alex Steele with Guy Johnson over in London. This is Bloomberg Markets. The headline last night was all about what's happening with the Hong Kong dollar peg. Apparently, some top advisors to President Trump want the U.S. to undermine the Hong Kong dollar peg as the administration is looking at options to punish China. The market doesn't really seem to be pricing any of that in yet, so we wanted to bring in back Kit Jukes of SocGen. Kit, the market's not really believing it. Like, would this ever happen, and how would it happen?
It seems an unlikely thing to want to have happen, and so unlikely to happen. I don't see how the U.S. wins anything from that. I'm not sure that if you wanted to hurt China, this is a terribly useful way of doing it. It ruins Hong Kong potentially as a financial center if you really create mayhem. So I'd have to understand. I think I'm probably like the market, not knowing how to react, because you read it and you think, why would you do that? I mean, what's the motivation for this? So stability is more likely. You do it by putting volatility into it. It's not clear to me. It's not clear to me how you manage it, and what you get to gain by managing it at the moment.
Kit, just hold that thought for a moment. We're getting some breaking news coming through from the Supreme Court in the United States. The president has not had a good run recently with the Supreme Court, but he is winning on this one. The Supreme Court backing the president on birth control, religious exemption. The Supreme Court is shielding religious schools from bias suits. So after a series of difficult decisions that have gone against the White House, one that is going for the White House, a obviously hugely polarizing subject in the United States, and one that's certainly going to factor in to what we think as we head towards the November election. Kit, I want to come back, just park that one for a minute, we'll come back to it later. Kit, I want to come back to the issue of the Hong Kong dollar. If there was a decision by the Trump administration to try and destabilize the Hong Kong dollar, would that at the same time undermine, and I think you're hinting at this, the US dollar's credibility? And would it be feasible for the Hong Kong authorities simply to say, you know what, we're not going to peg the currency to the dollar, we are now going to peg the currency to the yuan. We're going to peg it to the Chinese currency, and that would certainly fit the political direction of travel. What do you think about both of those two ideas?
I certainly think that from a Chinese perspective, you know, the Hong Kong dollar itself serves a purpose, but I've always thought that what they wanted it to do gradually over time was sort of wither on the vine and be replaced by the yuan. And then in the sense that if you accelerate that by destabilizing it, then yes, you have the option to say, look, that the dollar-yuan rate is something that they've been able to control pretty efficiently recently. It's not very volatile. You know, they use it every now and then in a small way, it would seem, as a political tool to demonstrate that they can control it. If they pegged the Hong Kong dollar to it, then I'm not sure how you destabilize it from the other side of the world if you do that, and you're pegging it to something that is itself not very volatile, is stable, the Chinese yuan now, and you know, it might just seem to them like, yeah, that's a perfectly viable alternative, and I'm not sure that it would help the credibility in that sense if the United States were trying to, you know, destabilize the Hong Kong dollar. It would kind of, the danger is that the world shrugs its shoulders. We reprice our, you know, I don't know, we adjust our Bloomberg screens to look at the Hong Kong dollar Chinese yuan rate and just move on.
So let me go back to something that you said before, which is you said that it doesn't really make any sense because Hong Kong is still a financial hub. Will it still be a financial hub in 6 months when we have these conversations, when companies are getting a lot of heat for still being involved? What do you think?
Well, I guess, you know, so I think it's certainly if the Chinese authorities don't want Hong Kong to be a financial hub, then they'll have to, you know, move that more to Shanghai or to other places. In terms of what it's, you know, Hong Kong serves a purpose for China, and there is a decision that's being made permanently about, you know, whether it's worth it for China to go on having this special treatment in that sense. Now, all the rest of us would like them to leave it as much alone as possible, but my sense is, as long as China is such a big trading partner of the rest of the world, and as long as China is a big financial player, it suits the world for Hong Kong to be a hub, even if it slowly shrinks in size over time, because we need to be able to transact business with China and transact business in Asia, and China wants something that's, you know, not on the mainland to be an avenue for doing that. So there's a lot of vested interest in working out a solution against which there's a lot of indignation, obviously, in places like the UK about what's happened. But I wouldn't underestimate the vested commercial interest in not just ruining the whole thing.
Okay, fair point. All right, thanks so much, Kit Jukes. Always good to catch up with you, Kit Jukes of SocGen. So some breaking news for you. Anthony Fauci is speaking right now at the UN Forum on lessons learned from the virus. So one, he says he's cautiously optimistic for a vaccine by the end of this year. He says phase 3 trials could begin at the end of July. S&P a little off the highs of the session. All right, coming up, we're going to speak to Wall Street's top bear who's raising his S&P target. We're going to talk to Tobias Lefkowitz, a Citigroup U.S. Chief Equity Strategist. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From London, I'm Guy Johnson with Alex Steele in New York. This is, of course, Bloomberg Markets. Alex, let's talk about where the S&P is going. Wall Street's top bear, a little less bearish. He's upgraded his S&P call this week. Citigroup's Tobias Levkovich raising his target to 2,900 from 2,700, saying that fiscal and monetary stimulus will offset uncertainties. He joins us now. Tobias, great to speak with you today. Thanks for your time today. Look, I guess the first question I have is a fairly straightforward one. We're at 3,100 now. What gets us to 2,900?
So look, there are a number of uncertainties that we need to get through. One of them is, unfortunately, the recent resurgence of coronavirus patients and, re-shutting down of things that had been opening. So it kind of protracts the time frame or elongates the time frame for kind of normalization of the economy. Number two could be the elections themselves, uncertainty around policy that could start. Companies might hold back making investments, hiring some people back until they have some better feel for what happens to tax rates, what happens to incentives, what happens to regulatory backdrops, things like that. And number three, we've lost 30 million jobs. Our economists believe we can get 15 million back, and we have 15 million who won't necessarily be back as quickly, and they may lose supplemental benefits on the unemployment side coming on August 1st. The current CARES Act $600 per week, if you like, supplemental unemployment checks do end unless they do something to extend it. Republicans don't want to extend it. Business people don't want it to extend it because there's some disincentives to come back to work. So we're going to have to see how that all plays out. So I think those are some of the factors that we're going to have to get a feel for.
Why haven't those factors mattered yet?
So it's a good question, Alex. I think, look, there have been some good news, and I kind of I'm a little amused by being called Wall Street's top bear, in that we were cautious in January when our panic euphoria model went into euphoria territory, sending a 70% signal that markets are likely to be down. At the end of March, we went into panic, 97% probably of markets rising, so we got more constructive when we were sitting at 2,200, and markets have now gone to more than 20 times next year's earnings that are still uncertain. I mean, it's nice that Dr. Fauci believes that we could have a vaccine, but rolling out the vaccine, the willingness to take the vaccine on its first kind of round, because in the past, vaccines that have come out have had to been tweaked over a period of time until there was greater acceptance around society to take those vaccines. So these are all kind of issues that matter, again, 6 months from now, but don't necessarily matter when the market's rising as we're opening the economy, as some of the data was getting better in terms of opening the economy and what that meant to earnings trajectory. So everybody got very short-term focused. We just ran too far. I think that's our concern right now, that everybody's too excited as if everything's going to be perfect. And it's unlikely to be perfect. We're likely to see volatility over the next several months. We kind of keep talking about something we call FOMO. So everybody knows what FOMO is, fear of missing out. But FOMO is fear of meaningfully underperforming. So when the markets are going up, people feel compelled to buy in the institutional world because they literally can't take the career risk of underperforming. And we find a lot of reluctant investors. They're long because they have to be, but they're not really comfortable there.
Yep, gamma hedging, all kinds of other factors into the mix as well. Tobias, liquidity has clearly played a major part in providing the upward momentum for equity markets. Where do you think the current strike price is of the Powell put, and how much faith do you think we should have in it?
So look, I think the Fed is not just the Fed, it's also the Fed's, in other words, the government stimulus side or the fiscal side, that there's going to be another stimulus package probably to extend some of the benefits. And again, the question is what, the magnitude or how generous government's going to be. And they're going to have to provide something, particularly before elections. But the Fed, I think can take a 10% pullback in market pretty easily. I think as you start moving into the teens, that's where they start to get a little bit more nervous. One of the data points we track is what percentage of S&P 500 constituents are down 20% or more from their 52-week highs. Back in late March, it was near 100% of the names were there. About 45% were down over 30%. And the Fed cares about the economic feedback loop. If stock prices are down dramatically, CEOs, CFOs look at it and say there's something ominous or sinister there, and they start scaling back their plans in terms of hiring, capital spending, building inventory. And the Fed does care about the economic feedback loop. So as we start moving down towards that 20% level, about 30% of the S&P today is at that level. If you start to see 50, 60, 70% of the names down, I think the Fed would find not the desire to make sure you and I are making money, but to make sure that the companies don't sit back and say, hey, let's defer plans. That's where their real concern is.
That's interesting. There's like another part to that feedback loop. Tobias, we only have about a minute, but with all that in mind, how much do you care about earnings? What's like the number one line on the balance sheet you're going to be looking at?
So I think people have kind of almost thrown away the second quarter. We kind of suggest that the investment community has given the market a hall pass, if you want to call it that, for the second quarter. We know it's going to be horrific. It's more about, can they provide some better guidance? Can they, give information to the money managers that things are looking better, that they've done a better job on structural cost reduction, because most people are really looking at 2021 earnings. And at that point, again, we need to have some better sense of normalization. There are estimates right now, $164 consensus bottoms up numbers. We're at 150. But 75% of clients have told us in a survey we did 2 weeks ago that they thought that 164 was too high. So we're going to have to scale some of that back. Another reason to believe the markets, again, maybe just a bit ahead of the skis.
All right, Tobias, got to leave it there. Thanks a lot. Really appreciate it on your call. 2,900 now for the S&P. Tobias Luktovich of Citigroup. This is Bloomberg.
So it's June 29th in Dublin, and bars are reopening as part of the country's reopening after the coronavirus. Pubs are open for the first time in 3.5 months. When we go into the bars, it's going to be a very different experience than it used to be. You have to order food. You can only spend 105 minutes inside, and you must sit at a table. You can't go to the bar. So last week we spoke to the landlord, Alan Campbell, who told us all about the regulations.
You'll have to sanitize your hands. You'll be met by myself or a manager. You'll come in. If you have a reservation, you'll be brought straight to your table. If you don't have a reservation, if we can fit you in, we definitely will. But we'll be taking your name and your details for possible contact tracing later on if necessary.
Now we're going to go in and meet a couple of friends. The first time you'll be able to meet friends in a pub since the middle of March. So let's go and do that. It's good to be back.
Yeah.
Cheers.
How's it going?
It's fantastic. It was really good. People were really understanding that they could only stay for a certain amount of time, and we had to take their phone number and stuff like that. So yeah, we were slammed all day. We ran out of food. We almost ran out of Guinness. So it's a great place. It really is.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From London, I'm Guy Johnson with Alex Steele in New York. This is Bloomberg Markets. Alex, we're wondering whether or not we're going to see some of these lockdowns that are being reimposed having an impact on demand for crude. We're about to get the inventory data.
Yeah, that's coming out in just a second. We were looking at weaker demand. That was from the API data from yesterday. So it really begs the question, does stimulus at any point offset demand destruction? The crude market was already dealing with that months ago. Now I feel like the rest of the economy is also dealing with that. So we did see a substantial build here in crude inventories, up by about 5.6 million barrels. Cushing had a big build. You did have a super solid draw, though, in gasoline inventories, drawing by about 4.8 million, which is much more than expected. But distillate inventory rose. It's really, you know, gasoline and then distillate and then jet fuel. That's kind of like what you're looking at when it comes to product pricing. And you're looking at refinery utilization, though, jumping about 2%. So the fact that refineries are working harder, but you still saw that kind of crude build, I'll be interested to see what kind of imports did we see, or if that is an export issue. We'll see, because that's a definite mismatch. But all of this also setting the stage for big oil earnings when they report in the next few weeks. So let's dig into the whole market here with Christian Malek, JP Morgan, head of EMEA Oil and Gas Research. Christian, good to talk to you. How do you see the supply and demand dynamic right now as we speak in this market, as the U.S. in particular is struggling with, can we really reopen, and sort of regional lockdowns?
Yeah, I think one of the main fears amongst a lot of the macro and commodity funds that we speak with is that we will see a sort of second and third wave emerge in terms of lockdowns. Now, one of the things I think is just worth noting is that expectations around demand are already quite low, in that there's a lot of concern about national lockdowns, not just in the US, but globally. What's interesting is that that's all translating into more of a localized, nimble approach, which I think in some ways is better than the original expectations, as we see a more sort of focused view around demand. What that means in terms of balance of supply demand is that, yes, we'll see potential renewed headwinds around demand, but it'll be far more localized and diluted than what we saw through March and April. If that's the case, then with demand growth continuing kind of through the rest of this year and supply still massively curtailed, the balance still points towards a deficit, although it may not be a straight line. It may be kind of quite sort of up and down, but ultimately still a deficit on the other side.
How nimble is the supply side going to be, Christian? You talk about the demand side looking a little bit more flexible as we get these more regional lockdowns. Is that going to be reflected as well in the supply side of the equation?
Yeah, absolutely. I mean, you've basically got to race to the bottom for both supply and demand. We saw the demand hit a sort of historic low through March and April, but equally we're seeing supply continue to come off. Now, where we've seen the biggest move or capitulation of supply has been big oil, so non-OPEC, non-US, not just the IOC international companies, but across the world. We estimate around 5 million barrels of production has now been has come offline, of which one is permanent, being laid to rest, or the other 4 is being deferred. And then in the context of what's going on in the US shales, that's continuing as we speak in terms of more and more rigs being taken offline, companies going bankrupt. So
that's an emerging, shale continues to emerge. Now, if I sort of bring the supply equation in terms of what we're seeing in terms of total supply losses through this year against the demand equation, which is assuming we see permanent damage of about 3 million barrels, what we're still left with is a deficit towards the back end of this year in supply demand, which we need to take inventories down. And that's ultimately what's going to potentially drive the price significantly higher as people start to see what the new norm for demand is. And with supply now sort of taken offline and permanently taken offline, we could see quite a sharp deficit emerge and surprise the upside.
So it brings up an interesting point, because there are two views that are emerging in the market. One is more along that line, that we will see a supply shock, and that you're going to have oil companies that are still levered to oil do really well because they're going to need all their product. Yeah. On the other hand, there's the story that we're not going to see that supply gap, and the companies that have transitioned, like a BP, like a Shell, may be in a better spot since they've already written down so much of their assets. What do you think?
Yeah, I think on the latter point, I mean, you raise a good point around the BP, the Shells. They've all sort of reset around $50 to $60 Brent, which I think is very bullish in the context of what production they're going to ultimately put back online. If they're now running this new oil price deck, even with all the efficiencies in the world, far fewer projects make the cut, Alex, in terms of being able to sanction those projects. So even through an oil price rebound and the majors then coming back and sanctioning renewed projects, only the highest cash flow, highest returns will be sanctioned, which therefore means that you still have a lot of production that's basically what you call stranded assets, being stranded and left alone, and they won't hit the market again. And that ultimately creates a bigger supply issue later on. But ultimately, yeah, the majors who have basically taken on a reset on the oil price deck will be better poised to come out and sanction projects on a sort of a new framework. I would add, though, energy transition, which is essentially what these companies are doing, could see a lot more capital taken away from oil and gas and put into non-oil or new energies, which in itself means that even if CapEx comes back into the oil sector, it won't come back in the same way.
Chris, I want to pick up on that point because I think that there is a kind of bigger question that is hanging over this sector. Why, as an investor, would I put money to work in an oil and gas company with all the legacy risk that that entails? Why wouldn't I simply just deploy that capital into greener companies which are forward-looking rather than backward-looking?
Yeah, I think it's a fair point, because you could buy an Ørsted or a utility company, low returns, but it's basically the future for energy. The issue is that oil isn't going away. As a house, we still believe that oil is going to be needed for many years to come. So why not have the best of both worlds, where you buy as equivalent of a hybrid, an energy company that can sell best-in-class oil barrels for fantastic cash flows. You know, we talk about managed decline. That could manage decline over 10, 20 years, not over the next few years, and still generate the cash flows to generate the dividends, which they've enjoyed in the past, but equally use that cash flow not only to fund the dividend, but to fund new energies. So you essentially have a barbell. And so the companies that we like are companies that can deliver best-in-class black oil, and by that I mean also low carbon intensity, because that's an important metric, as well as be able to position themselves for selling energy, whether it's power or other forms, which is essentially the future. So I'd rather go for a hybrid where you've got the best of both rather than one or the other, which I think is going to ultimately become no man's land if an oil and gas company can't figure out how to sort of transition through both forms of energy, oil and everything else.
I guess it depends on what your view is ultimately on the delta here, the rate of change away from oil, and that still seems to be determined, I think, at this point. Christian, really appreciate your time today. Thanks for running through all of this with us. Christian Malek, JP Morgan, joining us on the line. Let's check in on the Bloomberg First Word News and get an assessment of what is happening here. Rika Gupta, over to you.
Thanks, Guy. At the Supreme Court today, two key rulings involving religion. Justices upheld a Trump administration rule that lets employers use religious grounds to opt out of the requirement that they offer free birth control in their health plans. Meanwhile, the court also gave a victory to religious schools. Justices say the Constitution gives faith-based groups broad power to hire and fire employees who carry out important religious functions. The president of Mexico is taking the biggest gamble of his 19 months in office. Andres Manuel Lopez Obrador is in Washington to meet with President Trump. Despite the advice of some of his top counselors not to go, Lopez Obrador wants to safeguard the commercial connection between the two countries. Trump is reviled south of the border for having called Mexicans criminals and rapists. Warren Buffett has donated about $2.9 billion in Berkshire Hathaway stock to 5 charities. It's part of his annual giving plan. Berkshire says that Buffett has donated shares valued at more than $37 billion since he started his giving program in 2006. And is it time to break up some of the big tech companies? Bloomberg's Eric Schatzker posed that question to billionaire Barry Diller. The former Hollywood mogul sat down for a Bloomberg front row interview.
Google is the only is the only actual monopoly. The others have varying levels of competition. But they're absolutely, when you have monopoly power, you have to have regulation. And I think in the next couple of years, we'll probably get closer to it than we've ever been. I think that's healthy.
Global News, 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700.
All right, thanks so much, Ritika. I just want to point out the Florida COVID cases, hospitalizations come in at 333, so that's less than the previous day, and positivity rates over 14%, but still less than the previous day as well. So both of those are starting to come down. So coming up, it's how do you prevent a pandemic from happening again? What can we do to invest now to help us later? We're going to talk to Yana Ramus, a McKinsey Global Institute partner and economist, on their latest report on the need to prioritize health. This is Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York, I'm Alex Steele, Guy Johnson in London. This is Bloomberg Markets. So health is at the top of the agenda pretty much to every business and every person and investor around the world. It doesn't mean, though, the healthcare sector is immune from the pandemic. Wanted to take a quick check-in here on the sector's performance. Want to go Scarlett Fu, Bloomberg Senior Markets Editor. Hey, Scar.
Hi, Alex. Yeah, that's right. When the pandemic first hit, healthcare was really seen as a growth opportunity and as a haven because every company around the world, every country around the world was looking for some kind of treatment or vaccine. And demand for the sector skyrocketed. If you look at number of shares outstanding for XLV, the biggest healthcare ETF, you could see it began picking up in late February when COVID-19 first made its appearance in the U.S. It gained momentum in early April before peaking in May. And since then, we've seen a big drop-off. And that is reflected in the price action as well, because healthcare was the second worst industry group in the S&P 500 in the month of June after utilities, down 2.5% for that month when the S&P 500 rose almost 2%. According to the Bank of America Fund Manager survey for June, allocation to the sector plunged 18 percentage points month over month to only a net 30% overweight. And analysts say that a lot of it became apparent that COVID-19 was not a net positive for the sector, just seemed to hurt it less than other sectors. So what changed? For hospital operators, elective surgeries, which are high-margin revenue opportunities, were halted. Hospitals had to preserve space for, of course, just general admission. And for pharmas, companies working on some kind of virus remedy are under pressure to keep their drug costs low. It became apparent that any kind of vaccine would require a long road ahead. Also, election risk is creeping in as well. A Democratic sweep of the presidency and of Congress could lead to industry changes. At the very least, it would likely lead to higher tax rates. So as we get ready to embark on earnings season for the second quarter, analysts estimate that healthcare EPS for the second quarter will be down about 18% from last year. Kind of middle of the road, just like their performance. Guy?
Yeah, and then you overlay kind of the do I invest in the US or do I invest in Europe argument onto this. It becomes fascinating. Europe's got a lot of healthcare stocks. Scarlett, thank you very much indeed, as ever. Perfect setup for what we're about to talk about, which is prioritizing health and how we deal with the global pandemic that we're experiencing with COVID-19. McKinsey's latest Global Institute report, Prioritizing Health, a Prescription for Prosperity, analyzed over 200 countries over 2 decades to identify health challenges and opportunities that we all face. Joining us now is one of the co-authors of that report, Nerea Miles, McKinsey Global Institute's partner and economist. Thank you for spending some time with us. Look, I'm wondering if we could just focus a little bit on the pandemic and get an idea of what is happening here. The big challenge that we're all trying to understand is what can we learn from the COVID-19 pandemic that we can then apply to future pandemics, because inevitably they are coming?
Well, the COVID pandemic has been an unwelcome reminder of how much health matters for the global economy. We estimate the cost this year alone is going to be something of 3 to 8% of GDP. Yet every year, poor health reduces GDP by 15% globally, roughly the size of US economy today, because of premature deaths and ill health. So as we are recovering from the pandemic, health is now at the agenda of every organization, from the government to companies to communities. And it is a once-in-a-generation opportunity to really rethink our public health, as well as how do we able to not just return to the past, but dramatically enhance broad-based prosperity and health at the same time.
So, Jana, I think that everyone's going to agree that we need better health. People need to be healthier. They need to live longer and live well. You had a great stat in the report that said for every $1 invested, the incremental economic benefit could be $2 to $4. But my question is, who's responsible for that first $1? Is it individuals? Is it companies? Is it governments? Is it states?
So we have traditionally left healthcare to the healthcare providers, yet a lot of the actions that we need to see happen before a sick patient looks for care. And for that reason, what we really need to do is, now that health is on the center of everyone's agenda, is to keep it there for the long term and really start thinking about how we can think of health as part of the broader social and economic policies, how we can think of companies making sure that they are able to keep their employees and their communities as healthy as they can, and how we can really reform and rethink of how we can best use some of the lessons we have learned of the COVID pandemic. And I think it is an exciting time to do that because of the fact that we have seen a lot of innovation happening, both in the hospitals and the COVID wards, on the patient and employee flows, as well as in the innovation side of the vaccine generation. There is almost 150 vaccines in development, many of them across sectors and across countries. So I think this is really the moment to rethink how we can build a stronger health and economy for the long term.
Jana, one of the things that the developed world in particular has a problem with right now is productivity, and some of that, I assume, is healthcare related. Do you think COVID-19 and the refocusing attention on kind of prevention and weight and blood sugar and insulin and diabetes will be actually a wake-up call for societies to deal with some of those underlying problems, and by extension, therefore, maybe resolve some of the problems we're having with productivity?
Absolutely. So on the flip side of the cost of poor health today is that if we invest on better health, we can get a very high return. We estimate that we could add 10 years to the active midlife, to the healthy active midlife, which would make 65 the new 55. We could add 12 trillion to the global economy by 2040, which would translate into almost half a percentage point faster global growth. And companies would be the big beneficiaries. Sickness absences would decline. Healthier workers would be less distracted by caring for their or their loved ones' ill health, and fewer workers would retire early because of health conditions. So in many ways, there is a very strong case exactly right now when we need to address both health and the economy to invest on those areas where the economic return is the highest.
So I guess the question is how, and what did we learn from COVID? Like, I'd love to be 30 again. You have sort of an outline for what we need to do to sort of prevent another pandemic and fix things now. It's not just sort of lower blood sugar. I mean, it's, you know, surveillance, prevention, R&D, healthcare response, and then also personal care. Walk me through like the biggest one in that list.
So I don't think there's a single silver bullet for what we can do, but I can give you, for example, everybody has a role to play, and companies have a big part. And for example, we already talked about how pharmaceutical companies, the healthcare providers, and medtech companies can take the innovations they have seen and implement, for example, a lot of the digital innovations that we have seen applied to the COVID pandemic to chronic disease care, which is something where we have a lot to do to make sure that people actually do take their preventive medication, for example, which is a big challenge today. Similarly, now every company is thinking about how they can care for the health of their employees as well as their customers. And this is really an opportunity to think it much more for the longer term. We are seeing some of the biggest challenges for the productivity, to go back to your earlier question, Guy. Productivity is the fact that people who are suffering from mental health conditions or back pain or migraines, they have a hard time focusing on their work, and that reduces their productivity. I think we can find ways that companies can reduce the mental health stressors and make the workplace physically less stressful for those people. For example, as we are seeing aging workforce, we are going to have to find ways to keep our older workers motivated for a longer term and healthier.
All right, Reina, thanks a lot. I really appreciate it. Or Jana Remes, excuse me, of McKinsey. Thanks a lot. I appreciate that. This is Bloomberg.
Is there any reason why intelligence like this would be put in the President's daily briefing and it wouldn't be followed up in person directly with the President himself?
Susan Rice, the second Obama National Security Advisor, writes today in the New York Times that if she had information like that being reported in the papers, whether it was totally verified or not, she would have gone into the Oval Office to tell President Obama. So without getting into what I knew or didn't know, I just want to say I agree with Susan Rice on that point.
How would you recommend that President Trump extricate himself from this now?
In terms of the Trump presidency, look, it's just another day at the office. That's the way it works. Every day is a new day. Every story is a new story. What you said yesterday is interesting, but doesn't necessarily dictate what you say today. What it tells the Russians is we are in disarray and ripe for this kind of provocation.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Billionaire Barry Diller isn't a fan of the Trump administration. The IAC and Expedia Group chairman expressed his disappointment in a Bloomberg Front Row interview with Eric Schatzker.
I can't help but be disappointed by anybody in this administration other than the Treasury Secretary, who I think has done a very, very good job. And I'm sure there are other people who've done some good work. But this is a terrible administration.
New York City still plans to open public schools in September. Mayor Bill de Blasio said he anticipates a blended learning program. Students will be in class 2 to 3 days a week, and families may choose all remote learning over in-school programming. And that's your Bloomberg Business Flash. Alex, Guy?
All right, thanks so much, Ritika. So some news here in New York, Guy, that I will be very excited about is that the New York City mayor says that New York City schools will likely be open and be in person 2 to 3 days a week starting in September. Now, obviously, there's a lot of issues as who actually gets to regulate that. Is it Cuomo, the governor? Is it Mayor Bill de Blasio? And this really highlights a conversation that's unfolding here in the U.S. Trump really wants schools to reopen, is threatening to withhold funding. If they don't, the CDC is much more cautious, and it feels like education is now being drawn into another political issue.
Yeah, particularly as all the data seems to suggest that kids aren't likely to suffer as a result of COVID. Now, whether or not they transmit it, this is where life gets pretty interesting. But here in the UK, Alex, the Johnson administration has come under so much pressure with so many people arguing that it has mishandled school reopenings, that it has sent confusing message to the education sector, that I think it would be very, very difficult for the administration here in the UK to row back and change the way that it's approaching. The interesting thing will be whether or not parents actually send their kids, and there's growing evidence that a significant portion of parents, even if schools do reopen, will not send their kids back to school come September. We will, I suspect, have a few more weeks of data under our belt at that point before we get an idea of what is going on. The other thing that we're debating, obviously, at the moment, Alex, is whether or not we are going to see this shift towards Europe continue. Coming up next, Graham Secker, Morgan Stanley's EMEA equity guy, is going to be joining us. We'll get his take. This is Bloomberg.
last 30 years, I've managed through a number of crises myself, but nothing I've ever seen has ever been quite like the crisis we have now. I want to talk to CEOs and see how they're living through this crisis. Who is going to really manage their company in a way that people will remember it? That's what I want to know. This is Leadership Live.
My suspicion is that as the e-sport leagues become even more prevalent and popular, that you will start to see both peer-to-peer wagering and broad-scale wagering on the outcomes of these events.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Live from New York, I'm Alex Steele with Guy Johnson over in London. This is the European close on Bloomberg markets. Whatever the headlines are, Guy, here's the one from the U.S. Tech still outperforming, up over 1%. Forget that bearish close yesterday. It is still all about tech.
It's amazing to see it happening, and it is maybe an argument against why you would want to pull money out of the U.S. and put it in Europe. It's a debate, Alex, that Wall Street is having, and we're certainly having over here amongst the equity strategies community. Let's talk about where we are in terms of equity markets right now. As you say, U.S. equity markets looking a little firmer today. Over here in Europe, we're still trading on incredibly light volume, like really light volume at the moment relative to the 100-day average. Most of the main markets are down circa 0.5% to 1% here in Europe. Stock 600 down by 0.4%. The pound is a little bit, getting a little stronger as the afternoon has progressed, as we've seen Rishi Sunak, the Chancellor of the Exchequer, dish out an additional $30 billion for the UK economy recovery, a plan. HSBC, though, under pressure. We saw this start to emerge last night. It took us through the Asian session into Europe. It looks as if the Trump administration is going to take a harder line when it comes to Hong Kong. We'll be returning to that theme, Alex, of the UK mini budget in around half an hour. We're going to get more insight on what the British government is trying to do to kickstart the UK economy. We're going to be joined by Steve Barclay. He's the Chief Secretary to the Treasury, Rishi Sunak's number 2. That conversation live at 4:30 p.m. here in London, 11:30 a.m. over in New York. Alex.
We had cash for clunkers in 2009. You guys have like cash for food, basically. I guess that's what we're going to be talking about too. All right, let's get a closer look now at the markets and where we're sitting right now. Scar Fu is a Bloomberg senior markets editor. Hey, Scar.
Hi, Alex. Yeah, let's just give you a little more detail there on some of the numbers for the major indexes. The S&P 500 off its highs of the session, but we're still looking at a one-month high building on that advance. The NASDAQ and the NASDAQ 100 are at record highs. No surprise that you have record highs in Apple, Microsoft, Amazon, what we've been seeing the last couple of days. European stocks moving the other way, as Guy told us. And there is still plenty of demand for safety because you see gold prices moving above $1,800 an ounce. Now, speaking of safety, mega cap tech leading the way here. Look at these names. They're all at record highs right now. The big are getting bigger. They have a strong balance sheet. They've got undiminished demand for their services and products. That goes a long way. I like how Cameron Kreis, who is Bloomberg's macro strategist, put it in his recent note. This is a top-heavy rally. The NASDAQ 100, for instance, gets almost 50% of its market value from 5 names: Apple, Microsoft, Amazon, Facebook, and Alphabet. And you can really see it when you compare the NASDAQ 100's relative performance to the S&P 500, which is market cap weighted, that's the white line, versus the blue line, which is the NASDAQ 100's relative performance to the S&P 500 equal weight index. The spread between the two, going all the way back to June 2005 when the NASDAQ 100 launched, is 76 percentage points. Thanks to Dave Wilson for putting together that chart for us. Now, Guy mentioned HSBC. Let's just end with a quick look at European banks because Europe is down right now. And of course, banks are the leading decliners here. HSBC certainly in the spotlight as the Trump administration looks at it. Investec says it is out of arguments to keep an overweight stance on HSBC. It cites a deteriorating revenue outlook and recessionary costs, and it has downgraded the stock to a hold from a buy. We're also keeping an eye on Standard Chartered, another London-based bank that gets the bulk of its pre-tax profit from Hong Kong. We should mention as well, HSBC and Standard Chartered are 2 of the 3 banks that can issue Hong Kong currency notes in that city. Guy?
We'll talk more about this a little bit later on. Scarlett, thank you very much. People starting to talk about the S&P 500 being the S&P 5. As Scarlett said, very, very top-heavy. Now, let's talk about what's happening here in Europe in a little bit more detail. In her first official trip outside Germany since Europe went into lockdown in March, the German Chancellor Angela Merkel was in Brussels today, urging the European Union to unite to confront what she called the biggest challenge in its history.
In these times of crisis, we don't want to forget the other tasks ahead of us. Rather, we want to implement this for the future. That means that the money which we are wanting to use for the recovery won't simply be invested in getting us back to where we were. Rather, it will be a step towards the future. I believe we will have a good cooperation on this.
Angela Merkel, the German Chancellor and the official head of Europe, effectively, at the moment. Joining us now to discuss what the prospects for investment in Europe are, Graham Secker of Morgan Stanley. Graham, thanks very much indeed for taking some time to be with us today. A lot hinges on what happens next in Europe in terms of the way you approach your global investment portfolio. We are going to see a Eurozone summit in a few days' time towards the back end of Europe, a European summit, 17th and 18th, that some hope will nail down the program that Angela Merkel is talking there. This very substantial, some would say, program designed to help Europe's economy recover. But it's becoming more and more likely that we won't get a decision. Graham, if you're sitting on Wall Street right now and you're thinking of taking money out of the United States, how critical a decision is that in terms of your thinking when you look at what is going on with European politics?
Yeah. Hi, good afternoon, good morning, everyone. Look, it is super critical from a medium-term perspective that this happens. What I would say is, in my view, not critical that it happens next week, but it is critical that it happens certainly within the next couple of months. This is, we've been at Morgan Stanley right off the bat when this proposal was first announced, very positive on it and calling it a game changer. If you offer up something as significant as this and then actually, for any reason, take it away again, then I think that would be a very negative situation for Europe. But we're actually super confident that this proposal will ultimately get through. This being Europe, we don't always move in a straight line, and history would actually perhaps suggest that sometimes you need a number of summits to get it done as opposed to one. I think a short-term delay, markets may be a little bit disappointed, but ultimately I think we can look through that. A much longer delay or signs that the proposal is being watered down, I think that would be a much bigger challenge. People like ourselves who are making the case that Europe's due for a period of outperformance.
So let's get to the outperformance conversation. What's going to be the thesis behind it? Is it that the stimulus is going to be better in Europe than it is here in the U.S.? Is it a value trade? Is it the benefits for unemployment and businesses are different/better than they are here in the U.S.? What's the real thesis this time round?
Okay, so we think it's a risk premium thesis. It's not really a growth thesis. We don't expect the European economic recovery to necessarily be stronger than what we see in the US, and the size of the policy response in Europe is not as big as the size of the policy response in the US. But I'd put it like this. We've been worried in Europe for the last decade or more about the risk of a Eurozone breakup. And that has meant that risk premia on European assets has been elevated because of concerns of breakup. If this proposal passes, we think it signifies that the risk of a Eurozone breakup, it doesn't necessarily fall to zero, but it falls materially, and therefore political risk premia in Europe comes down. That should allow European valuations to go up. And I do think it's worth highlighting your own, Bloomberg do some policy uncertainty indices. And what you find there is that European policy uncertainty is already at a 10-year low relative to US policy uncertainty. So again, we could be in an interesting time here as we go into the second half of this year when you have obviously a presidential election in the US, which often can lead to a little bit more uncertainty and volatility, at the same time as potentially the political risk profile in Europe is falling quite materially. So for us, it's at this stage, certainly for the next 1 to 2 quarters, it's basically a valuation re-rating story for European assets.
Once you've had that re-rating, Graham, do you put that money to work elsewhere? How sticky do you think the money is going to be? After that re-rating happens, what is it that provides the catalyst for me to want to keep that money in Europe?
Yeah, no, I mean, look, that's a very good question. And I think, I say I would feel very confident on a sort of 3 to 6 month view that Europe can do better. I think longer term, that is more of a challenge. And just going back to some of the earlier comments on your show just now, Europe's lack of tech is a problem longer term. We've actually just written a report today, though, as a firm exploring how Europe might spend the money that it plans to raise with this fund. And it does depend how it's going to do that. And so whether or not it goes to sort of near-term stopgap spending or whether it's spent on longer-term investments, only time, of course, will tell. I think there are pockets in Europe, such as sort of the ESG angle and the green angle, that potentially can offer very attractive returns to investors over a multiple-year time frame. For Europe to really start to, so for the medium to longer-term outlook to be better, then we will need to see some inflation recovery and some stronger nominal growth. I personally think there's enough upside for Europe over the next 3 to 6 months that I'm not particularly fixated on what the next 1 to 3 years looks like. I think we'll cross that bridge at some point in 2021, but for now, there's enough upside, if you like, over the coming months if we can get this fund over the line.
We don't have that much more time, maybe like 45 seconds, but within that, do you distinguish between countries right now on a short-term basis?
Well, so focus on the periphery because that's one of the key the key beneficiaries of this proposal are financials and the periphery. So I think we just go where the money goes, if you like. That is, periphery over the rest of Europe would be the key country trade at the moment.
Yeah, don't fight the Fed, don't fight the ECB. All right, Graham Secker of Morgan Stanley, thank you very much for joining us. All right, coming up, the World Health Organization says the virus now hangs around water droplets. More on what we're doing to contain the pandemic and updates here in the U.S. from states. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The
The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Live from New York, I'm Alex Steele with Guy Johnson in London. So the latest here in the U.S. on the COVID headlines really has to revolve around schools. Within the New York City, the mayor saying that kids could go back to school in September, about 2 to 3 days. At the same time, President Trump really weighing in heavily on reopening schools, pushing back against CDC guidelines, saying they're just too expensive and too restrictive. So joining us now with more is a senior pharmaceutical analyst for Bloomberg Intelligence, Sam Fazeli. As this debate, Sam, of how to open schools here in the U.S. and when becomes really politicized, what's the science behind it?
Yeah, hi. First question for you, actually. Is there anything that doesn't become politicized in the U.S. now? I mean, this is, we got to try and deal with this from as scientifically possible rather than just making it a back and forth and a partisan issue, etc. But the science is we know that children generally, not there are examples of kids who've got the COVID-19 and have some horrific disease, but generally is that they're not infected. They don't get infected. Well, they get infected, but they don't get this sort of disease that we worry about. But of course, the risk is that they are still transmitting the infection, so we have to watch out for that.
In terms of what is happening right now with the science, Sam, I'm really struggling with one thing in particular, and I think the market is trying to figure this out as well. We seem to have a growing lag between the rising case count and mortality. In fact, mortality in the States is going down while the case count is climbing. Is it just that the lag is getting greater and ultimately these two lines do reconvene? Or is it actually that we have a different demographic, and as the age demographic gets lower and lower, it is unlikely we are going to see the mortality rate rising? Hospitalizations presumably are a factor here, and once those hospitalizations kind of start to get to a critical level, maybe they do kind of reconvene.
I mean, Guy, I have seen the hospitalization rates for a couple of states looking pretty horrific. But let's for a moment step back from trying to overanalyze. Let's perhaps celebrate the possibility that we have become better at managing this disease. Whether it's because the demographics shifting, whether it's because there is background immunity because I've been infected with some other coronavirus some time ago and I've got some kind of immunity to it in terms of managing the disease, or it's because our hospitals and our physicians have got better at dealing with the disease and finding people early enough to treat them, etc. So I think it's probably likely to be a combination of all of the above. As we've said many times together on the discussions, everyone's learning as they go forward, right? So let's hope that we don't see a spike in deaths. That would be great.
Overanalyzing, that's my jam, Sam. That's what I do.
Yeah.
So
hey, that's
if
my
that's
job
sort of
too,
the scientific, if that's the rational view, the scientific view, which obviously is getting very polarized here in the U.S. as well. As the disease then changes, as Anthony Fauci at the UN Forum was saying, talking about that, as it mutates and changes, does that then change the metrics we need to look at and change those milestones?
Yeah, so that is a, again, as you know, I have enormous respect for Dr. Fauci. So I think that's something that you will only know as time passes. When there is evidence that the mutation that's taking place in the virus is making it more infectious, but I don't know if there's evidence that the more infectious virus is also more deadly or more disease-causing. The story usually goes this way, that as viruses mutate, they become less severe in terms of the disease they cause. Now, only time will tell.
Sam, what is the significance of transmission via water droplets? Can you explain why that's a problem? I can understand in a country which had, say, a severe monsoon like India, how that would work, but explain the significance of why this is the problem for the rest of us.
You know, this is a problem for the rest of us if we're going to continue to play games with wearing masks. At the end of the day, there's been plenty of studies with laser photography, etc., that have shown, as I am speaking loudly now, I can be emitting water droplets that are sufficiently large to carry virus in them up to a meter away from my body. So that is how anyone in my vicinity who inhales those water droplets becomes at risk of actually contracting the infection. If I'm wearing a mask and if they're wearing a mask, obviously the risk of that becomes a lot lower. Now the next question is, how long do these water droplets hang around in a room where there's no air movement? That's the problem, right? So in office environments, in elevators, etc., and on trains and commuting and on planes, if there isn't good enough ventilation and folks aren't wearing masks, guess what? We're breathing in each other's water droplets, which is a pretty horrific thought.
I had a pretty novel experience the other day. I had my hair cut, and for the first time ever in my life, the hairdresser said that I wasn't allowed to talk. Normally, it's just chat, chat, chat. Sam Fazeli, thank you very much indeed. Sam Fazeli, Bloomberg Intelligence, senior pharmaceutical analyst, giving us the latest on what is happening with the virus. This is Bloomberg.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Welcome back. You're watching the European Close. Let's talk about what is happening in Hong Kong. I bring this up because HSBC is getting pummeled today on the FTSE 100, Alex. Eyes certainly fixated, though, on Hong Kong. Bloomberg reporting last night that President Trump, some of his advisors may be discussing a plan to punish banks in Hong Kong by destabilizing the currency peg to the dollar. The latest escalation in tensions between the US and the region, certainly a reason why HSBC under pressure. Henrietta Trace, Vida Partners Director of Economic Policy, joins us now. Henrietta, is this targeting the Chinese authorities, or is this targeting those that have business in Hong Kong? I'm wondering why the US would want to undermine Hong Kong and want to undermine the Hong Kong dollar.
That's a perfect question to ask. I mean, not only are they targeting Hong Kong, which would, in a way that would have massive repercussions to the U.S. economy, the U.S. stock market and exchanges and currency, but they're doing so, or theoretically doing so with this kind of a move, despite having many other options that would much more directly get at China and specifically banks that are helping Chinese officials in the CCP who are actually threatening Hong Kong's autonomy. As you know, there have been bills in the Senate and the House that have recently passed and gotten to the president that allow him to sanction not only CCP officials, but impose secondary sanctions on financial institutions in the PRC that have any involvement in facilitating this Hong Kong autonomy rule. So it's a fabulous question because there are other ways for the administration to go about it, and it seems like they are just pulling ideas out of the ether and thinking anything that punishes Hong Kong impacts China, and that should be our primary goal. But obviously, this specific move would have material blowback on the U.S. and U.S. exchanges and our currency as well.
So, okay, fair, but it's not just about an HSBC. I mean, here in the U.S., tech companies on their own, like Microsoft, Google, for example, Amazon, are trying to understand how they respond to government requests from China for data from Hong Kong users, what their role should be. What do you do if you're a company with a heavy presence in Hong Kong?
Yeah, that's exactly right. And we should consider that the question you're asking is actually exactly the one the administration wants you to consider. And we've seen that since the jump on the trade war, the threat of tariffs, the imposition of tariffs, the threat of these delistings or sanctions are all designed to get you out of China. Whether or not tariffs work or, an aggressive trade war with China is effective, the preliminary goal and the hope is that U.S. companies, whether they're tech companies or manufacturers, will decouple from China, or either organically or because of this political uncertainty. And that is a feature, not a bug, of this administration's U.S.-China strategy.
Henrietta, I've got a couple of seconds left. Is there a danger that this doesn't work out for the U.S. administration? If I was Hong Kong, I'd say, you know what, I'm not going to peg my currency to the dollar, I'm going to peg it to the yuan. And that just really makes the U.S. look impotent.
Yes, I think that helpfully there are a number of voices in Washington, D.C. who are stressing that point and trying to get the administration to back off some of these more maybe erratic moves and belabor to them that you want the United States to be the number one market, you want it to be the number one exchange to be listed on, and you risk undermining that by doing anything from the HSBC move to delisting Chinese companies from U.S. exchanges. That's absolutely an important component here.
Henrietta, thank you very much indeed for your time today. Henrietta Trays, Vida Partners Director of Economic Policy. United Airlines warning 36,000 U.S. employees that their jobs are at risk. We'll talk more about that. This is Bloomberg.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
European stocks wrapping up the day. It's been a very light volume session once again. We've had a number of factors to contend with, continuing uncertainty surrounding the virus. We have, though, watched US tech continue to drive ever higher. European equity markets kind of mid-range. We've got very, very light volume. One stock that is in focus right now, though, is United Airlines, warning 36,000 US employees that their jobs are at risk. Remember, at the end of the summer, the CARES Act money is going to run out. There was a provision when they took that money that they would not lay people off until the fall, basically. The process is going to begin to start, though. Clearly, with demand as it is at the moment, they are unlikely to be able to sustain cash flow in anything like the kind of form that they have been, and as a result of which they've got to slash costs. And this is ultimately going to fall on people. Two biggest costs for an airline, jet fuel and people. Jet fuel's come down. Probably not enough, and people. A lot of people are likely, therefore, to lose their jobs. Let's just talk a little bit about what's happening with the US and European equity markets right now. We'll deal with the European equity markets in a little bit more detail. We haven't had a great day today. Banks have been under a little bit of pressure, but as I say, it is a volume trade that is really worth focusing on. FTSE down, HSBC's a story there. DAX is down by nearly 1% today. The CAC 40's over 1%, down by 1.23%. We have seen a little bit of strength in the FTSE 100. Usually, if you see strength in the FTSE, a little bit of strength in the pound, normally that kind of feeds the other way in terms of pushing the FTSE 100 down a little bit more. Stronger pound, weaker FTSE 100, but that's not what we're seeing right now. In terms of the UK budget today, it did drive a few stocks higher, but it didn't have that big an impact. We'll talk to James Bourbon from CCLA in just a moment about that. There's the stock breakdown, more of a defensive bias today. Utilities doing better. The miners have had an okay day. China data continues to be fairly good, and certainly the equity market there driving higher. Gold's up today. Copper continues to be a story to focus on. The defensives like food and beverage doing relatively well versus the market, only down by 0.2%. But the cars, the banks, the construction sector, the travel and leisure sector, the media sector, all tracking lower. Let's take a quick look at some of the individual names. I just want to highlight what is happening here in terms of the single stocks. HSBC has been under pressure really kind of overnight since we saw that problem emanating out of Washington with the White House and staffers there talking about hitting the Hong Kong peg. HSBC down by 3.11%. First Group. Now, for those watching in the United States, this is a travel company. It has the Greyhound Group. It is under considerable pressure and has been falling. I think I saw some numbers earlier on suggesting the passenger traffic on the Greyhound buses down by around 80%. Persimmon, though, one of the beneficiaries potentially of what the Chancellor has delivered today, another demand stimulus for the UK housing market in terms of a cut in stamp duty. But the real focus, I would argue, today from what the Chancellor tried to deliver was on jobs. £30 billion are now being added to the UK stimulus programme that has been delivered thus far by the Chancellor, Rishi Sunak. Today, he continued basically pushing forward to try and protect some of the jobs. Here's some of the things he had to say on the economy.
I want every person in this House and in the country to know that I will never accept unemployment as an unavoidable outcome. Yeah. We haven't done everything we have so far, just to step back now and say job done. In truth, the job has only just begun.
In many ways, this was something you never would have expected from a Conservative Party government, but significant spending in terms of jobs and investment. James Bevan of CCLA Investment Management joins us now. There he is, the CIO. James, we've seen house builders doing relatively well today. We've seen some of the brewing companies doing relatively well today. Was there anything in the budget that kind of encouraged you to invest in some of these single stock names?
No, Guy, frankly, and when I look at the UK housing market, I don't think that this measure is going to be key to house prices. For me, the biggest influences on the housing market in the next year will be what happens to the job numbers and what happens on credit availability. Now, on the former, I do think that Mr. Sunak has laid out a stall that says that, as he has identified very directly, that he is very keen to ensure that people get back to work and have jobs. But ultimately, it's going to be credit availability, therefore, that becomes a real challenge. And I don't think that the stamp duty arrangements are in any sense addressing that challenge. And we are likely, I think, to see something like a 5% peak-to-drop decline in prices. And that is pretty much baked in the cake, I fear.
What about for, say, restaurants, pubs, things like that, I was making fun of Guy earlier. I was like, okay, so we had cash for clunkers, now you have like cash for a burger. You're basically getting paid 50% to go to a restaurant Monday through Wednesday. Like, does that help you feel better about that sector as an investment opportunity?
Well, I certainly think that we are in a better position than we might otherwise have been. But when I think about the medium-term prospects for the economy, I still think that we're going to be talking about an unemployment rate of between 6 and 7 percentage points by the end of this year, compared with under 4% at the end of 2019. I equally think that weekly earnings year on year won't move at all this year, and maybe rise by only 1% in 2021. And at the same time, whilst consumer price inflation in the UK may trough at about 0.6% year on year for the end of the year, I think that inflation will be up to 1.3% in 2021. So people will not feel well off. And we all know that modern monetary theory is fine so long as there is low inflation. The real challenge is, what is Mr. Sunak going to do? What will the Bank of England do when inflation pressures begin to rise? Will we still have big government? Will the government shrink back and say, actually, now we're going to put the squeeze on? And that is the big question the markets will need to wrestle with. For me, the big risk is bonds, not equities, however, because current bond yields are ludicrously low in the context of government needing to fund deficits.
It was really interesting, James, today. French linkers, French inflation-protected bonds. There was an auction. It was incredibly well received. Very, very strong demand. So people may be starting to position for that inflation surge that you're talking about. So how should I position my portfolio? Let's just start with the kind of the big picture stuff. If I've got a standard 60-40 portfolio, equity versus bonds, you're saying that the risk lies in the bond portion of that. How do I mitigate some of that risk?
Well, I would certainly look at the high-quality end of the equity market. That might take your gearing to equity prices simply through careful stock selection down to 80 to 85%. So technically speaking, I'm talking about a relatively low so-called beta. That, I think, would enable one to be focused on companies exposed to secular growth. And if I am correct in saying that we are going to have a difficult economic climate, I think that secular, meaning long-term real growth, is much more important than cyclical growth, meaning the amplitude of the upturn. So I am not subscribing to the view that we get a sharp V-shaped recovery. I am of the view that we get a relatively flat tick. In other words, a much longer period of recovery than markets are currently expecting. That, for me, therefore, is all about picking great quality companies. If I were thinking in terms of the UK, I would be talking about Diageo and Unilever. More globally, I think that there are some fantastic companies in the States like Stryker. In Europe, I'd be thinking about names like Diasorin.
What about China?
Do you know, I worry a lot about China at the moment because I would observe the mounting tension with the US. To me, that risks the unraveling of globalization, which has been incredibly important for the structure and function of the UK economy, where we are desperately dependent on being able to continue to import cheap goods and services from China. Equally, there's a lot of talk, as we know, about the weaponization of the Hong Kong dollar peg. I think there is a reasonable chance that the peg breaks. A lot of people, I think, may regard that as heretical. But if you go back to when the peg was formed in 1983, it came at a time when Hong Kong was facing the risk of hyperinflation. And the Hong Kong people put up with some terrible inflation and deflation periods in the 80s, 90s, and the 2000s. And the peg endured because people were prepared to put up with it. I now think that people's preparedness to put up with the peg, if it has disastrous consequences, the economy will be falling. So I would not be at all surprised if the peg does break.
Okay. Makes you wonder whether they simply just peg to the Chinese currency, which has been relatively stable against the US dollar, which would maybe cause Washington to have a little egg on its face. HSBC is a problem right now if the peg is going to break, though, James. Would you do you sell anything with exposure to Hong Kong? Would you sell any bank with exposure to Hong Kong? There are plenty of banks out there to own. There is plenty of bank credit out there to own. Why would you own HSBC? Why would you own Standard Chartered if that's the risk?
Of course, I agree with you. And I look at the great global banks like JP Morgan that not only are in effect price setters, but they have huge opportunity to get further cost-cutting and efficiency gains after the rounds of acquisitions that they are still bedding down. And to speak to your challenge of what happens to the Hong Kong dollar, yeah, I absolutely agree that in the fullness of time it is likely to be subsumed into the RMB, and it will simply become part of China.
All right, James, we have to leave it there, unfortunately. It was really great to talk to you, James Bevan of CCLA Investment Management. We do want to give you an update now. It's making headlines outside the business world. Here is Ritika Gupta with your First Word News. Hey, Ritika.
Hi, Alex. At the Supreme Court today, two key rulings involving religion. Justices upheld a Trump administration rule that lets employers use religious grounds to opt out of the requirement that they offer free birth control in their health plans. Meanwhile, the court also gave a victory to religious schools. Justices say the Constitution gives faith-based groups broad power to hire and fire employees who carry out important religious functions. The president of Mexico is taking the biggest gamble of his 19 months in office. Andres Manuel Lopez Obrador is in Washington to meet with President Trump, despite the advice of some of his top counselors not to go. Lopez Obrador wants to safeguard the commercial connection between the two countries. Trump is reviled south of the border for having called Mexicans criminals and rapists. Warren Buffett has donated about $2.9 billion in Berkshire Hathaway stock to 5 charities. It's part of his annual giving plan. Berkshire says that Buffett has donated shares valued at more than $37 billion since he started his giving program in 2006. And is it time to break up some of the big tech companies? Bloomberg's Eric Schatzker posed that question to billionaire Barry Diller. The former Hollywood mogul sat down with a Bloomberg Front Row interview.
Google is the only actual monopoly. The others have varying levels of competition. But they're absolutely, when you have monopoly power, you have to have regulation. And I think in the next couple of years, we'll probably get closer to it than we've ever been. I think that's healthy.
Global News, 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Guy.
Ritika, thank you very much indeed. European equity markets are now closed. We're through the auction process. We did see a little tick higher just in the last few minutes of the session, but nevertheless we finished near session lows. Unlike the United States, Europe is today finishing in the red, and it is the cyclical names that are under pressure. Banks are down, the car sector's down, the travel and leisure sector is trading lower, the defensive names catching a bid. FTSE's down by 0.5%, the DAX in Germany down by a 4%, the CAC 40 over in Paris down by 1.24%. We're going to carry on the conversation and get more detail on what the UK budget, the mini budget, delivered today. We'll do that at the top of the hour on Bloomberg Radio with the cable show. John Furrow's in New York. I'll be joining him here in London. We're on DAB Digital Radio. This is Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
In just 2 months, our economy contracted by 25%, the same amount it grew in the previous 18 years. Property transactions fell by 50% in May. House prices have fallen for the first time in 8 years, and uncertainty abounds in the market. We need people feeling confident to buy, sell, renovate, move, and improve. That will drive growth. That will create jobs. So, to catalyze the housing market and boost confidence, I have decided today to cut stamp duty. This moment is unique. We need to be creative. So I've decided for the next 6 months to cut VAT on food, accommodation, and attractions. I want every person in this house and in the country to know that I will never accept unemployment as an unavoidable outcome. Yeah. We haven't done everything we have so far. Just to step back now and say, job done. In truth, the job has only just begun.
The job has only just begun. The UK Chancellor of the Exchequer, Rishi Sunak, speaking earlier in the House, unveiling a £30 billion economic stimulus plan. Joining us now with the details of that plan, Rob Hutton, Bloomberg UK government reporter. Rob, in so many ways, this was what we expected, money being shoveled out of the door. My question to you is, was there a sense from government today that we will have to do more here in Britain, that the job is not complete, that this is just an interim step? How much more expensive is this scheme going to become to protect the UK economy?
Well, I think they'd love it. They'd love it if they didn't have to spend any more. But I actually think that the message, the sort of the underlying message that I picked up from Sunak today was that if in September they judge that they haven't done enough, that people are still looking at laying off large sections of their staff and this sort of thing, that there are particular sectors that are in trouble, that he would be willing to come back. I mean, the strangest thing about today's statement, in a way, is that
is that we had it at all in March. We had a budget, and that was supposed to be the budget that was going to deal with the virus, and then that was out of date within a fortnight. And he was announcing other stimulus measures and putting the whole nation on furlough. And since then, we've just had a series of interventions. And I think there's a sort of implied promise here that if more is needed, more will be spent.
So if I just focus on the labor part of it, I just wonder if what they announced today is going to be enough to offset when the furlough protection rolls off, or if come September they'll need extra boost, things like promising discounted meals in restaurants, paying employers to bring back their employees, and basically giving money to young people who can't work. Where do you land on that?
It's just so hard to know. And the thing is that this is lots and lots of little individual things. I was talking to one small business earlier in the week who have had a very nice lockdown. The chap sort of said, well, I spent 3 months in the garden, the government's been paying me, and now I've come back to work and everybody's queuing up. It's great. I was talking to another business, a pub, where they said, well, we can function as we are, but actually to start bringing our staff back, to start serving people properly with the existing rules, that wouldn't work. So I think a lot of this is about just trying to say, look, give it a try. Try taking people back on. We will help you. Here's a little incentive, and let's see if you can get to January. Let's see if we can just kind of almost bump start the economy again. Just get it rolling, and then we'll. In my car metaphor, we'll put it into gear and we'll see if the engine starts going again. And lots of this stuff just seems to be aimed in that way.
If the engine does restart and the UK the economy trundles off, did we listen to a future Prime Minister today, Rob?
I think Rishi Sunak would be quite happy that question was being asked. Aside from the massive economics of all this, the thing that really struck me was that if you looked at all of the branding on this, the social media, even the press releases, they didn't describe it as a Conservative effort. They didn't describe it as a British government effort. They described it as Rishi Sunak's plan. It's Rishi's plan for jobs and growth is actually what the press release says, most unusually. Everything is branded as being, I'm Rishi Sunak, I'm doing this. That must be being done with some level of consent from the Prime Minister. So I think they are trying to build him up. He looks very popular at the moment. The thing that everybody says about this is, well, it's easy to look popular when you are just spending billions of pounds on things that people want. So the hard thing will be if it doesn't work. But if it does work, you're right. You've got somebody who's suddenly quite well set up when Boris Johnson decides that he's had enough and would like to move on, or possibly even before Boris Johnson has decided that he's had enough. You've got somebody who's quite well set up as sort of looking good for BPM.
So in a politics sense, like if there was something here that unveils like Trump's job plan to fix everything, Democrats would hate it no matter what was in it. Is there not that kind of divide or pushback within the British government? Like, are we looking at it as sort of a unified thing, everyone sort of unifying against one person, one thing?
The opposition Labour Party had a go today at criticising this. But the trouble is actually there's not much that they can criticise in the policy, because broadly this is the sort of thing that they think ought to be done. So their criticism is more around in fact, things that are being done by other bits of the government, which are, is this the right moment to be trying to get people back out onto the streets, back into restaurants, back spending? Because if there's a second spike of the virus, and the virus is still very much around in the UK, isn't this just going to make everything worse? And interestingly, so their criticism wasn't that much of the things that Sunak was doing. And indeed, you could find Labour MPs being really quite approving of the things he's doing, because broadly these are the kinds of things that they've always wanted to do, massive state intervention in order to sort of stimulate the economy.
Yeah. If only things were that simple, as I learned in the U.S., it is not. Rob Hutton, thank you so much. Appreciate you joining us. So just some breaking news for you here. So Johns Hopkins University pointing out that the U.S. coronavirus cases are now topping 3 million. Also, Governor Cuomo here in New York offering some more information. He says that New York City schools will reopen. That decision will come in the beginning of August. He did wind up saying, though, that malls would be able to reopen as well. I'm just trying to find the exact headline here. He does say that it's a state, not a federal issue when it comes to schools. Anyway, so more updates here in the U.S. on the coronavirus. Cases now topping 3 million. This is Bloomberg.
Is there any reason why intelligence like this would be put in the President's daily briefing and it wouldn't be followed up in person directly with the President himself?
Susan Rice, the second Obama National Security Advisor, writes today in the New York Times that if she had information like that being reported in the papers, whether it was totally verified or not, she would have gone into the Oval Office to tell President Obama. So without getting into what I knew or didn't know, I just want to say I agree with Susan Rice on that point.
How would you recommend that President Trump extricate himself from this now?
In terms of the Trump presidency, look, it's just another day at the office. That's the way it works. Every day is a new day. Every story is a new story. What you said yesterday is interesting, but doesn't necessarily dictate what you say today. What it tells the Russians is we are in disarray and ripe for this kind of provocation.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Finally found that headline for you. Governor Cuomo of New York saying that malls on July 10th can reopen in the phase 4 regions with air filters. So that actually buoyed some optimism for the S&P, which is now flipping into positive territory. The school debate, though, raging here in the U.S., turning into very much a political issue and state-federal issue. All right, that wraps it up for Guy and me here in New York. Coming up, Balance of Power with David Weston on Bloomberg TV and radio.
Wanted it to be brutally simple. We didn't want tracking of people. So the device does not know where you are or what you're doing. Hi, I'm Joel Kubold. I'm 25 and I'm a co-founder at Fermana Tech with a background in engineering.
My name is Vignesh Murugan. I'm 22 years old and I'm the other co-founder at Fermana Tech. My background is in astrophysics. Proximity Power came about after we received a distress call from
member of an organization quite fearful that they were going to have to shut down the company during COVID-19. They were scared that they weren't going to be able to keep their staff safe.
So when you are 3 meters apart from someone, you'll be in the green zone. Once you reach down to the 2 meter distance, you will then be in the yellow zone where you're now warned that you might be too close. Once you reach a 1.5 meter distance though, you will now be warned with a red flashing light, vibration motor and a buzzer. I actually was going to do a PhD in astrophysics.
I was co-founder of a team to build the first semi-autonomous Mars rover, assist the first astronauts to go to Mars, and the two of us, along with the rest of the team, went over to Utah to compete at a NASA facility there. We decided to kick into gear to create a device that required no infrastructure throughout the business, but a standalone unit that would do nothing else than keep people safe and employed.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York to our TV and radio audiences worldwide, this is Balance of Power, where the world of politics meets the world of business. I'm David Weston. We start again today with a report on the markets. For that, we turn to Kaylee Lyons. So, Kaylee, not a lot of conviction, but NASDAQ seems to keep tearing on up.
Yeah, that is absolutely right, David. We've actually seen the S&P 500 flip between positive and negative territory. Right now, it's up just a few tenths of 1%. The Dow is basically flat. But once again, as you alluded to, it is a tale of tech outperformance. The NASDAQ far and away the outperformer on the session. It's up about 0.8%. This index just continues to climb higher. And David, of course, that is thanks largely to the heavyweights within it. I'm thinking the big five stocks, the Apples, Microsofts, Facebook of the world that continue to just power this equity market higher. It seems investors really just seem to be favoring these names over any others, given the fact that they are high growth, that they have strong balance sheets, can weather any kind of economic downturn, and of course, the fact that they have services and products in which are more demand in a stay-at-home world as we continue to see virus cases climbing. Johns Hopkins University saying just moments ago we have now hit 3 million in the U.S. And that's reflected in the sector composition in the equity market as well today, David. We see that it is technology, of course, outperforming up a full 1 percentage point. Well, at the bottom, it is those more cyclical, growth-sensitive sectors, industrials, energy, materials are all lagging very hard in today's session, David.
Yeah, which takes us really back to the coronavirus, as you suggest, Kay. That makes sense. At the same time, gold has been climbing pretty steadily. Where's the dollar?
The dollar is actually weaker today. It's interesting. We're getting kind of mixed messages from each of these asset classes in that usually a weaker dollar indicates more risk appetite, more confidence about growth. But you aren't seeing that reflected in gold. As you alluded to, gold is now at its highest since 2011, so 9 years. It's above $1,800 an ounce. We see ETF holdings in gold, for example, at record highs. So clearly there is still appetite on the part of investors to hedge some kind of risk here, even if the markets are moving higher because big tech is carrying us, David.
And at the same time, the VIX is relatively modest considering where it was before. The VIX is not indicating a lot of volatility.
Yeah, we're right around a 29 handle today, but it is all relative when we talk about volatility. Yes, we're not at an 82 like we saw back in March, but we are still elevated relative to history. Right now, the VIX would indicate that we're expecting swings of nearly 2% daily for a month on the S&P 500. Again, not March, where we were implying that the market was going to swing 5% a day. Wasn't all too out of the question then. Today, the market isn't seen as swinging that much. But again, relative to history, that is still quite elevated. That fear gauge is still a lot higher than it has been historically, David.
Okay, Kaylee, thank you so very much for that report on the markets today. That's Kaylee Lyons, one of our colleagues here. Meantime, let's go back to that subject of the coronavirus and how states are really fighting against it. We're very pleased to welcome now back to Bloomberg Ned Lamont. He is the governor of the state of Connecticut. So, Governor, thank you very much for being with us. I mean, it's a good day, I think, for you to come on because last time I saw you reported 0 fatalities for the first time since March. At the same time, you have postponed indefinitely the Phase 3 reopening. Why the caution when the numbers seem to be doing so well for Connecticut right now?
Nice to see you, David. We've got about 95% of our economy open right now. But when it came to bars and nightclubs and big entertainment venues, I listened to governors from Florida and Texas and the such saying they regret that they did open their bars when they did. And that was an opportunity for some super spreading to go on. We don't want that to happen. So, in abundance of caution, we're not going to open them yet.
Well, an ounce of prevention is worth a pound of cure, as I recall, which makes good sense. How concerned are you about people outside of Connecticut? Certainly some surrounding states, even New Jersey now seems to be ticking back up, but certainly in the South and the Southwest, there are concerns about people coming from those locations into the states up here in the Northeast. How concerned are you about that? I know you have a quarantine in place. Is that advisory, or can you enforce that?
I'm very concerned. Thankfully, we got good neighbors. Massachusetts, New York, Rhode Island, they have low infection rates. But you're right. If people are flying up from Miami, flying up from Houston, coming in unchecked, that's a problem. You need one or two people infected on that flight by the time it lands. Who knows what's going to happen? So we do have a quarantine in place. It is voluntary. That is true. But I'll tell you, the number of people flying into our state from those infected areas has dropped quite a bit, which is the precaution we wanted.
Governor, where are you on masks? I mean, some people are going to like mandatory masks now. Where are you in Connecticut, and you as governor of Connecticut?
Yeah, we have said for indoor use, to stores and the such, you have to wear the mask. That's the rule. And I was sort of interested, David, reading today that the National Retail Association said, I'm tired of having 50 different rules for when it comes to masks. Have a national standard, say masks are required inside the stores. That would make our lives a lot easier. That's the National Retail Association.
And most public health officials agree that that's one of the things that we could do to really save lives, save people from infection, but even save people's lives. So what's the hesitancy? Have you talked with federal officials about the possibility of a federal standard on this?
They're reluctant to have federal guidance on things like that. You've got to ask them. The messaging coming from Washington has been a little confusing for us. That's why we as governors here in the Northeast like to speak with one voice so we could have a consistent message.
One of the things we've heard a lot about is certainly testing, but contact tracing as well. I saw a report having to do with Connecticut that suggests you could reach out to 97% of the people who are infected, but only 47% would agree to participate in the contact tracing. Is that a problem for the contact tracing to really be effective?
That is a problem. We now have the infrastructure in place, as you point out. We can reach out to just about everybody in a real time. We do it by telephone. We do it by text. We try and say, look, if you care about the family, you care about the friends, the people you've been in contact with, please let us know who they are. But there is some hesitancy out there. Young people are at the party, don't want other people to know who was at the party, that type of thing. And we're working with the communities to impress upon people how important it is you share this information.
What is your policy at this point on the schools reopening? This is certainly something President Trump has focused on. Yesterday, he really said he was going to urge governors like you to make sure you open your schools. We had Vice President Pence out again today. At the same time, we had Mayor de Blasio here in New York City saying, if we do this, it's going to be like 2 or 3 days a week kids can go to school. Where are you in Connecticut?
Because we have an infection rate less than 1%, because we're meeting all the metrics, we are planning to open our schools on time in late August, September, a normal school day, so there's not a lot of back and forth, some days on, some days off. I think that's better for the kids and certainly for the employers and getting our economy going again. They'd like to know what the work schedule is of the people who are working for them.
Are you going to test employees, at least, if not students, before they go back?
Right now, that's not the CDC guidance, but we do have 160 testing centers. They're available free of charge, symptomatic or non-symptomatic. So for those teachers that want to be tested, we're going to make sure they have that opportunity.
Governor Lamont, we all hope this goes beautifully for Connecticut and for the rest of us, for that matter. At the same time, do you have contingency plans? Do you have contingency plans that you could cut back again, in some schools at least, if there are problems, and go to a remote learning?
I'm afraid we do, David. I mean, we've seen how fast this flare-up can spread like wildfire, looking at other states. So we have told K through 12, make sure we have a contingency plan, And in particular, our colleges. I mean, they're thinking hard about how they might have to move back to online learning if, in fact, there was a flare-up in the residence halls and the such. I think it's terrible, by the way, that you're not going to let foreign students attend our great universities here in Connecticut if it involves distance learning. That sends the wrong message, and that's coming right out of Washington.
Well, as you suggest, Governor, you have some pretty big, important universities there in the state of Connecticut. How are they doing? What's going to happen to them financially, given what's happening right now? Because you have both increased costs and perhaps reduced revenue.
They're losing money in the residence halls in particular, where they can't be at full occupancy to maintain some distancing there. But right now, I believe all of our colleges, public and private, are getting going in August. They're going to start with some distance learning to get people up to speed, move people into the dorms slowly, maybe over 2 or 3 weeks, so there's not a mad rush going in there. And they plan to have a mix of online as well as in-person classes, knowing that they may have to take a turn if there was a flare-up.
Governor, when you were last with us, you said that you thought perhaps the days of the routine 5-day-a-week commute from Connecticut into Manhattan may be over. What changes in patterns have you seen since then? Has that reinforced your view, or do you have a somewhat different view?
No, David, it really has reinforced our view, especially in southern Connecticut, where a lot of people would get on the train, then they get on the subway. There's a lot of reluctance about getting on the train, a lot of reluctance about getting on the subway. And I think people have found that you can have a nice suburban lifestyle, or maybe live in one of our small towns or Stamford, Connecticut. You can work out of there 2 or 3 days a week, and if you have to get into the Big Apple to take care of business, you could do that, but you don't have to live there.
What longer-term changes, besides the commuting issue you just raised, are you taking a look at right now? I'll give you another example. There are a lot of reports of people in Manhattan looking for houses up in Greenwich, up in southern Connecticut, and out in New Jersey. And what's going on with the real estate market right now?
The real estate market is very, very busy. People coming from New York, people coming from Boston. I think if they feel like this may not be the end of the end when it comes to the nature of self-quarantining, if you have a house with a little backyard, or you can get a couple of extra rooms at less cost than perhaps Brooklyn, it's a pretty good place to be. So I think you're going to see a dynamic change. Let's face it, for the last 20 years, young people wanted to be in the major metro centers. Now I think there'll be a little balancing out.
Well, Adam Smith would say that when there's increased demand, the price is going to go up. Are you seeing home real estate prices go up in Connecticut?
I think you are seeing some of that. Yeah, we've been pretty flat, as you know, for the last 15 years, so there's still a steep discount for Connecticut compared to New York City, for example. But you're right, there's a lot of demand, and I think you're going to see that reflected in prices.
So, Governor, let's talk about what, if anything, the state of Connecticut needs from the federal government. There's talk about another phase of stimulus or investment, shoring up the economy coming perhaps later this month. You've said you don't think necessarily we should be extending that $600 supplemental unemployment insurance claim. Why is that?
I'm trying to do everything I can to get people back to work safely. That's how we're going to get our economy going again. That's how I'm going to stabilize finances in our state. So I thought, look, there are other ways you can use those federal dollars rather than just true up the unemployment. For example, you know, we've lost hundreds of millions of dollars just because not just our income tax revenue, but our sales tax revenue is down a lot due to COVID-enforced restrictions. And we've got to be prepared for that. Thankfully, we have a big rainy day fund, so we can power through for the near term. But if this lingers on for another year, we're all in big trouble. So I really need the federal government to step up and help out the state and local governments and give us more guidance on education as well.
So it's great that you have a rainy day fund. It'll tide you over for a little bit. When does it really start hitting you? If you don't get some direct support from the federal government for the Connecticut budget, when do you start having to cut costs? And let's be frank, that's often laying off people.
Well, we're already trimming. There's no question about that in anticipation. I think Connecticut's in good shape through this calendar year, maybe a little beyond that, depending on what the balance is. we're assuming as our economy gets back towards normal or close to normal by the end of this calendar year, well, Connecticut will be in good shape. If this falls over, if there's another big flare-up in November, you know, we'll see what happens.
Governor, obviously this pandemic and the economic problems that have followed the pandemic are a big crisis. We also have had a crisis in this country having to do with the systemic racism following the heels of that tragic killing of George Floyd. Tell us what is going on in Connecticut. I understand you may be calling the General Assembly into special session to address some of, at least the policing issues.
We're definitely going to do a police accountability bill as part of our special session in the next couple of weeks. We tried to lead by example with our state police and make sure that when it came to community policing, take out the militarization, focus on the community policing. And I was really pleased that during some really important protests in and around the George Floyd murder, our state police were also often arm in arm with the protesters. We had very few arrests, very little violence. And for that, I was thankful that the police and the protesters were, in many cases, aligned, at least in terms of their goals.
What about the more fundamental underlying issues, besides the policing of some of the inequality, economic inequality, income and wealth, that we have across the entire country? You also have a version of it in Connecticut. What can we do to address some of those issues that really set up perhaps the police and the police for failure?
Yeah, two big focuses for me in our state is one, education. We have one of the biggest achievement gaps between extraordinary suburban schools and some of our city schools that we've got to make investments in. We need more social workers. We need more social support, you know, as well as STEM and coding. So we're making a big effort to upgrade those opportunities there for each and every one of those kids, especially the ones in the cities. And secondly, we put a lot of money into new business startups, especially for, you know, people of color, making sure they get that opportunity. We have a $45 million fund. I think 38% of it went right to people of color to make sure they can power through and start up their business and achieve their dreams.
Yeah, fascinating. Finally, Governor, let me ask you about voting come November. We've got a big election coming up. What's the situation in Connecticut with respect to absentee voting, mail-in voting? It's a big controversial subject, as you know, across the country.
Why is it so controversial? A majority of states do it. Red states, blue states is not particularly partisan. Obviously, in this environment, everything is getting partisan. In our state, look, I'm telling people over the age of 60, I'm telling people with pre-existing conditions, stay safe, stay home. And that means we got a primary in August. That means we have an election in November. And I want to make sure they can exercise their rights through absentee balloting. So we've got a little push and pull on that, but I think we're going to get that passed.
And do you need something through the General Assembly to get that done? And if so, when does it get enacted so people know how they're going to be able to vote?
Yeah, I have emergency powers, so I can do it for August. But when it comes to the November election, I need the legislature to step up and say, if you feel like you have some health risk, you don't have to go wait in a long line at a voting booth. We'll do absentee balloting for you, no questions asked. And I noticed that the CDC just recommended the same. That's good news.
So, Governor, I told you finally I'm going to fib to you now because we got a question from a viewer that I really want to ask you. One of the viewers wrote in and said, how's your pension system doing up in Connecticut?
We need some work there. There's no question about it. The politicians made big promises, didn't put money into the pension for 40 years. We have an unfunded liability. That said, we're pushing through some reforms. We have a fair number of people that are going to be retiring in the next year or so, and we're managing it. The main thing I'm trying to do is hold down the increase in costs so our fixed costs become a smaller and smaller piece of our budget over the coming years.
Okay, Governor, it's a great pleasure to talk with you. Thank you for so much of your time. That's Governor Ned Lamont. He is governor of the state of Connecticut. And this is Bloomberg.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for Bloomberg First Word News. For that, we go to Mark Crumpton.
David, thank you. A grim milestone here in the United States. According to data compiled by Johns Hopkins University, the number of confirmed coronavirus cases in the United States has topped 3 million. More than 131,000 Americans have died. The U.S. accounts for more than a quarter of all COVID-19 cases globally. President Trump is speaking out against the CDC. In a tweet, the president said he disagrees with the Centers for Disease Control and Prevention's, quote, very tough and expensive guidelines for opening schools. He added the CDC is asking schools to do, quote, very impractical things. The president has threatened to cut funding to schools if they don't open before the November election. Brazil's President Jair Bolsonaro says he's confident that he will quickly recover from the coronavirus thanks to treatment with hydroxychloroquine. On Tuesday, President Bolsonaro said he had tested positive for the virus. He's been downplaying the severity of the illness for months, while deaths in Brazil soar. He said today his fever had subsided, something he attributed to hydroxychloroquine. The drug has not been proven effective against COVID-19. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Travel, we did not know when it was going to return. And we knew that when travel returned, it would be different. It would never be the same.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.